Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Rosine. Thanks for joining me today. I'm going to be reporting flows for the conventional fund business for the week ended Wednesday, January 15th. And, we've had some ups and downs this week as far as, economic news come out and then some other things. Actually, we were kind of stunned by the jobs report. Lower than expected jobs report came out, considerably lower. The market originally didn't respond too much to it, but by Monday, they were, actually sending it really down to the sellers, and then it turns around and we get some really good news. We had the Fed actually come in and with these good news and say, hey, we might increase the tapering bit a little bit quicker, and that kind of sent the markets into a funk. But really, after we saw the numbers come out on retail sales and also on earnings, investors again came back to the market. We saw about $8.1 billion in net outflows for the conventional fund business, but again, it's not as dour or bad as it looks. Well, let's take a look at our macro classification to see how this actually panned out. We take a look at it. Equity funds actually had a great time, $5.1 billion in net inflows. S&P 500 actually set another record. Taxable bond funds also had inflows, $2.3 billion. That's kind of odd. And then muni bond funds broke a 33-week losing streak. They actually took in a little bit under $100 million. But again, positive, breaking the streak. Maybe that'll be a trend. Who knows? And then this is where we lost the money. Money market funds, about $15.6 billion of net outflows. Certainly makes sense with people trying to put money back to work. And also with the break of the new year, people are actually taking their money and putting it other places. They parked it for a little while, and they may have some, year-end receivables they have to take care of, or maybe taxes they have to take care of. So we expected some outflows from money market funds. So this certainly wasn't a shocker. Let's go ahead and take a deeper dive on equity funds to see where the money went. There was a lot of money that went in there. Again, we saw about $5.1 billion the fourth consecutive week we've seen inflows. But if we take a look at the returns, 0.81% for 1 week is not bad, almost a percent return for the week. And it's the fourth week in 5 we've seen positive returns. Now, how this broke out, domestic equity funds took in about $3 billion. I want you to keep that in mind because we're going to get to the equity ETFs in a little while. And we're going to see that was not the case for ETFs. And this is the first week in 3 they've seen positive flows. On the flip side, we're looking at non-domestic equity funds. They actually took in $2.1 billion. This is the fifth consecutive week they've taken in money. And how this broke out is we actually saw large cap funds taking about $1.8 billion on the domestic side. And then when we took a look at the world equity funds, we saw that international domestic or developed markets actually took in a big chunk of the money, about $1.6 billion went into that group. And of that $1.6 billion, we saw about 0.5, about $500 million go into the emerging market funds. So really people are still focused on international developed markets rather than emerging markets, but they certainly warmed emerging markets as well. $500 million went in there. Let's take a look, though, at this tale of two cities I was just referring to for equity ETF funds. Equity ETF funds for the second consecutive week saw outflows. This time it was about $1.4 billion. If we take a look at who took in money, iShares core S&P 500 saw about $306 million come in. iShares MSCI, the EMU, that is basically the Eurozone ETF, basically taken in 269. But what we saw people take money out, and maybe this is where authorized participants are giving a little bit of tell here, is we saw that the S&P, the Spider S&P 500, that's SPY, lose about $1.5 billion. And then what's been in favor, iShares Russell 2000 actually saw about $1.2 billion. So we really saw a change of pace. Authorized participants were running for cover, actually probably just covering some of their open positions ahead of this 3-day holiday we're coming up for Martin Luther King Day. That's probably the real truth. But certainly it has some concern that authorized participants are behaving somewhat different than the average retail investor. Well, let's see what happened for retail investors when we take a look at fixed income funds. For the second consecutive week, we've seen inflows about $2.3 billion. This is the sixth consecutive week, though, that we've seen plus side performance. Wow. And all this change that we've been seeing, and all this bit about cuts and the Fed and like that kind of stuff. So this is really kind of amazing that we've seen some pretty good numbers as far as returns go. 0.4% as far as a return. Nothing big or anything to write home about, but certainly a positive return. And again, that's kind of amazing considering what's going on. How that expanded out, though, is we take a look at the corporate investment grade debt funds. They took in about $1.8 billion, and of that, loan participation accounted for $900 $190 million of that, so almost more than half of it. And certainly if we take a look at Flexible, which I don't have up here, they took in almost $1 billion as well. So really, the old corporate investment grade, the IID, intermediate investment grade debt funds, they actually saw outflows. But of the group, again, they saw some major inflows. And for the loan parts, it's the 83rd consecutive week, so people are betting that, in fact, we are going to have a raise in interest rates. Obviously, the Fed has told us that, and they're interested in getting into these adjustable rate type of funds. So that certainly was a trend. And we take a look at government mortgage funds. There we saw some outflows, only about $199 million, so it's not a big deal. But of course, government and treasurers are still getting crushed from this move. Let's take a look at our ETF group, though. Our ETF group, very minor outflows, but we did see outflows, about $184 million. This is the fourth week in 5 that we've actually seen outflows. And to bring in money, we saw the PIMCO ETF 0 to 5 year high yield corp. So high yield and short duration certainly was the kind of flavor of the week. It's been so for a while. $96 million in inflows. The iShares short treasury bond actually took in about $80 million. So I'm kind of surprised treasuries took it in. But again, we're at the short end of the curve. People are still looking for safety, especially if they don't know what's going to be going on here in the future as far as the economy goes. But if we take a look, the iShares 20 plus treasury actually saw about $282 million in outflows. And then if we take a look at the next few, are all long duration bond funds, they saw outflows. So how did this then translate over to muni bond funds? Well, muni bond funds actually saw their first inflow in 34 weeks. $57 million, not much to write home about, but again, we've been commenting on the kind of slight decrease we've seen in outflows. And then all of a sudden we have a week of inflows. Maybe people realize that they're throwing the baby out with the bathwater, and there are some problems. Detroit debt, those investors doing some of the foreign debt with Puerto Rico. It's not foreign, obviously, but doing muni bond fund investment there and the troubles they're having there. But really, if you take a look at the majority of other ones, certainly there's a reason to be able to go back in. Yields are much higher than their treasury equivalents as far as along almost the entire curve. So that was quite a story. And then again, national munis actually took in 180, so we know single states actually lost money. Again, people kind of bailing out of some of the certain areas, but certainly this may be a trend setter and maybe the inflection point we've been looking for munis. Let's take a look at our money market funds. Money market funds, second consecutive week, saw significant outflows, $15.6 billion this week. How it broke out, we had taxable money market funds losing about $13.8 billion. Of that, institutional accounted for 7.1 versus retail investors taking out about $6.7 billion. And then when we take a look at tax exempt, they also saw about $1.8 billion in outflows. This is really not surprising for us, folks. When we take a look at money market funds at the end of a quarter, certainly people start packing it away before the end of the quarter, and then they start putting it back to work after we turn the quarter. So this was not a big deal at all. So what do we expect going forward? Well, I'll tell you something. We're going to expect more volatility as people become more concerned about where the Fed is going to be looking for, how they can maybe cut back on their tapering, how aggressively they should do it, and whether we get good numbers. Well, this morning we actually saw some really good numbers. Industrial production and capacity utilization beat expectations, and that is a signal that, in fact, our economy may be heating up a little bit more than just plunging along and getting those numbers just barely. This may be a good sign for us. If that's true, we may see some people, bail out of the equity markets to see what the Fed's going to do. But we do believe that the market is set for some good returns coming up, maybe a short pullback for a while, and that's what we're going to keep an eye on. Well, if you want to do a deeper dive into some of the areas that you've been doing research, you can certainly go to our website at lipperusfundflows.com, or you can return next week and watch one of our videos as our analysts will talk about flows for that week. Thanks for joining me, and I appreciate you guys all attending, and I wish you the best in your portfolio creation and management. Thanks, and have a good day.